The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Alphabet and Apple trying to do their best to keep the bull run going. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Katie Greifeld. We're kicking off to the closing bell here in the U.S. As Romaine mentioned, those two names trying their best, but boy, we can see that momentum fading as we speak. The S&P 500 higher by about 0.1% if you round up. We were higher by much more earlier in the session, but dropping a bit. It is big tech that's in the lead today. You can see that in the Nasdaq 100, higher still by about 0.3%, though even there you have seen gains come in, all because, or at least part of the reason why, we got weaker jobs data in the form of the jolts this morning, really casting some skepticism over this rally. We get those all-important NFP figures on Friday, but you can see that bid already coming into the bond market. 10-year yields down 5 basis points. But Bitcoin rallying right now. We're going to talk about Bitcoin a lot on this program, higher by about 0.5%.
Yeah, and take a look at the price action. And we should point out here that a lot of those concerns about lofty tech valuations, that is being put on the back burner here on this Wednesday. Momentum and growth, those are the factors that are leading the way forward here on this Wednesday afternoon. Steve Chiavarone out with an interesting note, basically saying to buy into these dips here, advising folks right now that with corporate earnings growing, economic data good, and Fed rate cuts appearing imminent, then now might be a time to buy. Julian Emanuel at Evercore ISI, he agrees.
Valuation is always in our mind, but at the end of the day, valuation alone is something that doesn't end bull markets.
And we've heard this before, and hopefully that sentiment holds, at least for this week, with 5 companies, at least of note, said to be looking to IPO, including digital payments firm Klarna, the Winklevoss crypto exchange Gemini space station, and maybe in a sign of risk appetite, the Trump-backed crypto miner American Bitcoin. It began trading today, and at one point in the session, more than doubling. A conversation with Eric Trump in just a few minutes. But of course, while the price action on the surface does look decent, a majority of the S&P stocks are still, again, lower. Alphabet and Apple, they're really the only thing right now keeping the S&P from slipping into the red. And then there's the economic picture. Katie just alluded to it. Data today showing a pullback in job openings, suggesting companies growing a bit more cautious. But here's the upside, potentially. Maybe that forces the Fed to offset by cutting rates to keep things humming.
Of course, that is one of the bets that's out there in the market. Let's talk about where money is actually moving right now. August finally behind us, and I thought this note coming at us from Citi was really interesting. If you take a look at the ETF flows, which is pretty much my favorite thing to do, fixed income out in a big way, taking in nearly $50 billion, second only to domestic equities here. This isn't something that you see all that often, to see bonds really in the spotlight like this, neck and neck with equities, Romaine. Usually it's one or the other, but we can see that fixed income equities neck and neck this past month. Of course, we'll have to see how a potential rate cut coming in about 2 weeks' time changes the calculation here.
Always love a look at the flows, because the flows, to a certain extent, never lie. Scott Chronert joins us right now, U.S. equity strategist and global head of ETF research at Citi. To kick us off to the close. And how about those flows, Scott? When we talk about that groundswell into fixed income, what should I read into that?
Well, Romaine, I think it's a really good observation. I mean, it's fascinating that you had record ETF flows into the fixed income category during the month of August. I think really what's going on here is it's one more indicator of two things. One is that expectations for an incremental Fed rate cut in September are coming, and that's being priced in and into the flow action. The other is that as you do your stock bond valuation math, as equities move higher, you do set yourself up for a natural rotation and sort of a reallocation effect that presumably plays out of equities to a certain degree and into fixed income. We're seeing that more in mutual fund equity flows than in ETF equity flows. All told, though, the flow picture is telling us that there's a pretty decent underlying bid for both fixed income and equities, particularly to play into this buy pullback narrative.
That sort of momentum that we're seeing in fixed income, it makes sense to me. When we talk about the momentum in the equity space right now, Scott, are you seeing any signs that that momentum might be ebbing just a little bit?
You're certainly seeing it. I think the way we're talking about it is that we're coming off of this really good Q2 where you had a lot of upside surprise, a lot of follow through in terms of growth expectations and a lot of follow through in that AI picture from a CapEx perspective. What that's done, though, Romain, is that it's lifted, I think, expectations going into the Q3 reporting period, which is still over a month away. But essentially, our measure of implied growth says that the market at some level here is beginning to price in an ongoing expectation of persistence of earnings growth. And what that does is it does set you up periodically for, my gosh, how much better can you get in the short term to keep the action, to your point, on the positive momentum front going. I think there we're looking for a little bit of a pause here over the next month or two.
Yeah, Scott, it's a good point. There's a lot priced in at this moment. I do want to go back to that chart, though, of the ETF flows, because something else caught my eye in addition to that big fixed income bar that you can see there. Global/international stocks taking in about $13 billion. You can see that the appetite was really for domestic equities. And this is a question that I've been asking all year, is when you finally see the U.S. stock market take back the leadership baton from Europe in particular, but the rest of the world as well. Is that something that happens by the end of 2025?
Well, I think, Katie, the way we're talking about it is that we're big on this broadening narrative, okay? And there are like three different paths that broadening can go. One is more broad within S&P 500 sectors, away from the mega cap growth, tech, communication services playbook into other sectors. Another is down cap in the U.S. small mid cap, and there we are seeing some signs of interest picking up even in the ETF flows. The third, of course, is broadening globally. And that obviously was a really strong play earlier in the year when tech was under pressure around that DeepSeek drama. Since then, though, what we've seen is a fairly persistent flow into the international cohort here. And yeah, I think it's for a couple of reasons. It's a little bit more comfort that we're getting closer to the end of some of the geopolitical conflicts. You got fiscal stimulus coming our way in Europe. And then on the emerging market side, I think the worst of the tariff concerns are behind. So you've got lots of avenues here for this broadening play. We're sort of on board with that. But against that, we would say we're not in the camp that we're losing U.S. exceptionalism. I think that's with us on a structural basis.
Okay, so American exceptionalism, it's alive and well. But speaking of this broadening, you mentioned the different size tiers here. And when it comes to the mid caps, when it particularly comes to the small caps, we've seen so many false dawns, Scott, when it comes to the performance there. It feels like they can't catch a sustainable bid. When you think about the earnings picture there in that particular space, I mean, can the fundamentals actually back up some of the optimism that we've been hearing now for at least a year?
Yeah, it's a really good question. And, you know, we were preaching this broadening tune a year ago at this time into 2025. We ran into, I think, a lot of the policy consternation around tariffs, et cetera. But that setup is in place again. The earnings picture for U.S. small cap is that for the better part of 2, if not 3 years, it's been in an earnings recession, if you will. If you look at what we're expecting out of the Fed, which is the market pricing in 2 further cuts this year, we're looking for 3, perhaps 5 as we get into the Q1 26 timeframe. What you begin to do, Katie, is set the small cap universe up for a more traditional early cycle rotation feel. Now, if we can do that without actually rolling into a recession, which I think is a pretty high probability at this point, then what happens is that you get a little bit more of a rate impetus that plays into the setup against easy compares for growth to come back pretty decently for the small mid-cap sectors going into 2026.
Scott, always a great conversation. Great way to kick off the show with one of the best in the business. Scott Chronert, U.S. equity strategist and global head of ETF research at Citi, as we count you down to the close here in the U.S. with an eye down south to what's going on in Mexico. We're going to talk to the CEO of the Mexican Stock Exchange when we come back after the break. Stick with us. This is The Close on Bloomberg. Let's talk Mexico. Its flagship stock exchange sees a future in the futures market, launching CME E-mini IPC futures in late August, a defining moment for the maturing exchange known as the Bolsa Mexicana, especially as emerging markets drive global equities to record highs. I'm pleased to say we're joined right now by the CEO of the Mexican Stock Exchange, Jorge Alegria, joining us here in New York, in Studio 2, and you're in the U.S. primarily courting U.S. investors. Let's talk about the listing back in late August. IPC, futures on the CME. A lot of people saw that as, if not an acknowledgement of what the Mexican stock market can offer to U.S.-based investors, certainly some degree of legitimacy.
Yes, that's right. What we are trying to do is, in this segment of the futures market, is to provide access to international investors to the Mexican market. So, although we have that same contract listed in the Mexican derivatives exchange, liquidity is thin compared with what we think we can do in terms of volumes and accessing new and more investors globally. So we have a partnership with S&P Dow Jones on the construction of the index, and we license this contract to CME as well. So now we have a much broader distribution to attract global investors who, at the same time, to hedge that, they may need to go to the Mexican stock exchange to hedge that with the underlying security. So we see that as a win-win strategy to increase the liquidity in the Mexican market and the visibility globally for our markets.
What do you anticipate in terms of growth in that, in terms of new entrants, new investors, taking advantage of that liquidity, taking advantage of that visibility?
If we use some international ratios on futures versus cash, we should be able to double the size of the derivatives market and link to equities in the next couple of years. And this is where we are aiming for by attracting these new investors.
I want to talk about listings a little bit more. We know in the U.S. for a long time, it felt like the IPO market was absolutely moribund. We weren't seeing a lot of activity going on. That has started to change, at least in the U.S. What do those efforts to drum up more activity in Mexico look like?
Mexico, we have been not very active in the IPOs till lately. We had an IPO last month on the real estate space, a REIT, which was very successful. But we have a new rule, a new regulation in place that the Mexican government published last year, and we are starting to see those benefits that are aiming to attract more companies to the stock exchange by making this listing process more simple, more and faster. So that's what we are doing together with the authorities, the Mexican brokerage community, to increase the number of IPOs, and now aiming not only big names, but also medium-sized companies that may benefit from these new rules to issue not only stocks, but also bonds to be listed in the exchange. So it's a regulatory effort combined with a very strong educational and training effort on our side.
It's interesting. You're seeing those same type of calls in the U.S. market as well. Let's simplify the listing process. But a trend that's been really underway in the global public equity market is that you see a lot of companies switching their international listings to the U.S. as their primary listing. And I wonder if you're having those types of conversations trying to convince Mexican companies to stay with their listing in Mexico.
Yes, we have those conversations, and I think we have been successful in transmitting the idea on that you can do both. So you can have an international listing in the U.S., get what they claim a better valuation. That's possible. That's true because again, they are more broader base of investors. But also you have the local market where you have just customers, right? The people that is identified with your brand. Some local investors maybe benefit also from tax advantages to local individuals. So I think taking advantage of the free flow of and the currency movement between the Mexican peso being one of the most liquid currencies in the world, you can list in both markets and get the benefit of those dual listings.
You're in New York this week, primarily to court U.S. investors, to sort of show them what can be possible investing in Mexico. I am curious, though, a lot of the interests that U.S. investors have had in diversifying outside of the U.S. have partly been because of trade policies that could potentially hurt Mexico. What do you tell those investors with regards to the balance between the risk and the reward?
I think Mexico being so close to the U.S. and historically being a partner in terms of trade, I think Mexico will end up being strong in terms of this reallocation of resources due to changes on trade policies. It's also reallocating resources to different markets, not only the U.S., for the last 5 years having a big let's say, concentration, even Mexican investors investing, let's say, a good portion of their assets in international markets. Now, I think this is helping us actually to see the emerging markets, particularly Mexico, as a very attractive alternative for diversification and value. And I think Mexico is going to be ending up pretty strong in the coming months and years.
Well, we know it's a busy week for you. Really appreciate you taking the time to come to studio. That is Jorge Alegria. He is the CEO of the Mexican Stock Exchange. Now, coming up, it is the biggest week of the year for U.S. IPOs. We'll speak to 1789 Capital's Paul Abrahimzadeh about what his Donald Trump Jr.-backed investment firm is targeting next. This is The Close on Bloomberg. It's the U.S. IPO market's busiest week of the year by volume, with pay-later giant Klarna and the Winklevoss twins crypto exchange Gemini making their public debuts. The SPAC comeback playing a notable role as loosening regulations and market appetites drive more money into those blank check vehicles. 1789 Capital, the investment firm backed by Donald Trump Jr., has made a few plays in the SPAC space and may stand to benefit from this IPO surge. We also heard some rumblings via a Bloomberg scoop that the firm may be setting its sights on real estate as well. Let's talk about all that now with 1789 Capital partner Paul Abrahimzadeh joining us in studio. Great to have you with us. Let's start with the IPO market. Broadening out from just SPACs, I feel like it's a similar conversation that we're having in M&A, that you are seeing this uptick in activity, but I feel like we've been here before. How can you be confident that the pickup that we're seeing is sustainable?
You've had a reduction in growth across the public equity market as companies pivoted to profitability post-pandemic. This market in public equities is starved for growth, and the IPO asset class that's now coming public is very much going to deliver needed growth into the equity market. So I think there's pent-up interest in these companies. Many of these companies that you referenced that are going public in this window were slated to go public in late 21, missed the window, and have now had 3 or 4 years to fine-tune their businesses, maintain strong growth, show a path to profitability, really get to revenue scale, and be positioned very well for a strong reception in the IPO market.
It's funny that we were just having that conversation with the CEO of the Mexican Stock Exchange and the challenge there of making the IPO process simpler, less onerous for companies. It's just, again, something that we're seeing in the U.S. as well. So it sounds like, listening to you, though, you don't think something fundamental has shifted, because the narrative is out there that companies don't really need to go public anymore. They can get all the funding they need in the private markets.
We only operate at 1789 in the private market. There is a long list of fantastic companies that we have financed and are going to finance. That being said, the reality is the lowest cost of capital is in the public market. So the pressure on companies to go public, I think, is going to increase, in particular as you see the recent IPO class trading at fantastic multiples. You look at the 3 most recent high-growth IPOs in the form of Figma, Circle, and Bullish, trading between 20 and 30 times forward revenue multiples. That is fantastic. On a growth-adjusted basis, it's even rich versus the current class of public high-growth stocks. And we think that trend will continue. There's a backlog of ultra-high growth companies growing 50% plus that will elicit very strong reception in the market. So from our perspective, it's very early in this monetization cycle for private companies to go public.
I am curious about that. I mean, there's been a lot of talk about the health of some of these private companies, the potential companies to come public, but also about this idea that if they've gotten this far, in terms of being able to grow their business, being able to attract capital, and being able to provide some liquidity for that capital, do they necessarily need the public markets anymore?
It's a great question. The reality is it's onerous to be public. Ask any public company CEO and CFO. The reality is doing perpetual private market tenders for employees and early shareholders is also work in and of itself, and you're highly dependent on the strength of the capital markets. Take a look back to the April window when the private markets shut for a multi-week, frankly, 1 month plus period around the time of Liberation Day, readjusting to the new tariff regime. It was difficult in that market if you had to finance yourself and you were private. If you were public, you still had access to the market through ATMs or follow-on equity offerings or the convertible market. So the access to greater pools of capital by being public is still a major advantage. You've also got the fact that many of these companies are long in the tooth in the private market. Their LPs in the underlying funds need liquidity. They're going to be pushing for a public exit.
Yeah. I am curious about valuations overall. There's been a lot of talk about a potential bubble in public markets. But there's also, when you look at the private space, there are a lot of companies with really outsized valuations that don't necessarily have the growth rates. Just while we were speaking, there was a headline, CNBC reporting a new round for OpenAI, putting it at $500 billion. I don't think anyone doubts their growth story. But there are a lot of other unicorns out there that don't necessarily have the sizzle and the pedigree that an OpenAI has.
It's a great point.
Yeah.
Not every private company is made the same. I think there are plenty of private companies that will not have the same reception in the IPO market. Many will stay private for longer. But the best of the best, which are lining up to go public, we think in the next 12 to 18 months, based on our dialogue with those companies, our dialogue with banks, we think will be very well received. Again, the highest growing, highest multiple public tech companies are growing 27 to 30%. Very long list of private growth companies that are scaled with growth meaningfully in excess of that, which will be very well received in the public equity market.
Let's talk a little bit more specifically about 1789 Capital. I mentioned, of course, that Bloomberg News had a scoop this morning that you're said to be holding talks for a $1 billion real estate fund focused specifically on South Florida real estate. Can you confirm that? Are you looking at real estate?
We are building a multi-pillar platform within asset management. So we started first with the growth equity fund. We've been incredibly fortunate to go from $150 million of AUM to $1.3 billion in a short period of time. We're approaching 50% deployed on that $1.3 billion. And we're looking now at the next leg of that pillar. Real estate is an obvious adjacency for us. Don Jr., one of the best in the business, comes from a lineage of real estate experts. His acumen is going to be incredibly important as we move into the real estate vertical. We're partnering with the Frisbee Group. They're one of the preeminent developers of retail and commercial real estate in the South Florida market. 30-plus year track record in South Florida, community-based approach to improving the communities where they operate and build. We will also have a data center and hyperscaler component of that capital outlay to pursue land acquisition and permitting, monetizing relationships we've built within that cohort. So we think it's going to be very diversified. We think strong returns based on the track record at Frisbee Group and with Don, and excited to build the platform with that new pillar.
Paul, we have to leave it there. Wish you had more time. Really great stuff. Paul Abrahimzadeh over at 1789 Capital, talking about, of course, his investment strategy over there at 1789. And Katie, as you just sort of tried to get out of him, maybe a potential foray deeper into real estate.
Yeah, we'll continue to follow that story as well. Of course, we're talking about 1789 Capital. That includes Donald Trump Jr.
Yes.
And we have another Trump joining us.
Donald Trump Jr. I don't know, is he the better known of the Trump sons? Because we have the other Trump son coming up here. In fact, one of the hottest trades out there today is a company called American Bitcoin, making its NASDAQ debut, at one point actually doubling during the session. A conversation with the co-founder, Eric Trump, when we come back after the break. This is Bloomberg. Let's get right to our top calls. The big movers on the back of analyst recommendations. And we're going to start off today with Alphabet. JP Morgan raising its price target to $260 from $232, maintaining an overweight rating. The analyst citing a, quote, favorable U.S. antitrust ruling that avoids a forced sale of Google's Chrome browser. The shares rallying the most since April 9th, and $229 and change. That is a record high. Up next, Constellation Brands, the maker of Modelo beer, Mondavi wine, and High West whiskey. All of Katie's favorites. BNP Exane downgrading to underperform from neutral, reducing the price target to a street low 123. The analysts citing persistent structural demand issues. Those shares, which have already drawn down about 50% since the last record high, now down about 3% here on the day. And finally, let's take a look at Six Flags. Truist not feeling the fun. A downgrade on the amusement park operator to hold the price target slashed to 27 from 45. Concern being raised over the company's high exposure to lower income customers. That stock, which we should point out, hit a 5-year low just last week, actually getting a slight bid on the day, up about 1%, up for a second day. Now, we do want to stay in the consumer space and take a closer look at Macy's. They reported earnings earlier today and having one of their best days in year after it raised its annual outlook after reporting its best comparable sales growth in 3 years. A big question now as to whether that can continue. Oliver Chen is Managing Director of Consumer Retailing and Senior Analyst at TD Cowen, and he joins us right now. And Oliver, we know Tony Spring, since he took over back in 2024, has been trying to right this ship. I know one quarter does not necessarily make a trend, but were you encouraged by the results we got today?
Yeah, I am excited about what's happening there, cautiously optimistic. It was the first positive comp in 12 quarters, so we love seeing growth. However, there's a lot of work to be done. The comp was around plus 1%. Keep in mind, Walmart and Costco are doing 4 to 7%. So critically, Macy's needs to get younger customers. They need more consistency, and they need fewer promotions as well as a better shopping experience.
You know, I spoke with Tony Spring earlier this morning, shortly after the earnings release, and I asked him about promotions. He kind of said, look, you know, we'll do it as we see it, right? He really wasn't committed to it, but it also didn't sound like promotions were off the table. I think in the past, certainly before he got there, Macy's was basically the place you went to when you wanted to buy something on sale. Do you think they could kind of break free from that, where they could kind of be a little bit more full price and not just when I have a coupon, I go there?
Yeah, you're right. What they really need to do is work on their own brands. So there's product you can get there that you really love that you can't get anywhere else. They also need to work on faster inventory management because, as you know, in the age of TikTok and social media, fashion is changing so rapidly. And then making it convenient, making it fun. Retail, I teach a class at Columbia. It's like everything, everywhere, now at once. And consumers demand that, and they want great fashion at a low price. That being said, the Macy's shopper is really yearning for better service and yearning for fashion. It's a company that stands for fashion, and that's how they do need to play. Bloomingdale's is part of it. They're doing great.
Yeah, that's interesting. I do want to talk a little bit more about pricing. It's interesting to, at least what I think you're saying is that it doesn't matter as much the price sensitivity as when it comes to Macy's as maybe some of those other aspects of the experience.
Yeah, it's a big balancing act. Consumers today, no matter what, are seeking value. But value does not necessarily mean price. It means great features at a reasonable price too. Macy's is going to have a hard time always competing with TJ Maxx, Shein, and others. And standing for fashion and selling goods at more fuller price, that's the journey / opportunity ahead. And that's what they want to be, with better service, better product, and innovation. That's what customers want. But at the same time, this is a tough consumer environment with lots of cross currents. Our recommendations are Walmart and Costco and BJ's. Keep in mind, those are very value-centric retailers. And as you mentioned, Romaine, Macy's is really trying to manage these margins tightly. Margins got worse because of tariffs, and they're also trying to keep flexibility for having promotions. They had to mark down goods in the beginning of the quarter, too.
But to that point, though, too, I mean, when I spoke to Spring earlier today, he talked about how they kind of want to, they basically offer something for kind of the higher end consumer and something for the lower end. You talked about bringing in new brands. You mentioned fashion earlier. They had the, what was it, the Alex Friedberg partnership, and then on 34th. And then I heard that Christian Soriano from Project Runway, he's going to do his fashion show at Herald Square.
Yeah, so the beauty of the business model is a certain degree of diversification between Bloomingdale's, Bluemercury, and Macy's. The important part Tony's bringing up is this need for specialness, and we all want to be inspired. And this is a want product. It's not a product that we desperately need, like food and milk and chicken. So you always have to create. You have to create relevance, because you want to look good, and you want the mom to love it, you want the daughter to like it. It's happening more in beauty, but apparel's been a tougher space. So a lot of what Tony understands experiential, we believe in him. He's a merchant. And bringing all that action back to the stores, I really want to see it happen.
Right. Fathers and sons, they can go wait outside. I do actually want to talk about chicken and milk, because to go back to what you said, Walmart, as one of, maybe your favorite names in this environment, Walmart is so much more than just apparel, for example. I mean, they sell staples. They have that big grocery business as well.
Yeah, Walmart is a nice combination in this environment with this bumpy consumer, because you get a 60% of this business being grocery, but as you think about the online marketplace, you can buy vintage Hermes on the online marketplace. You can buy La Roche-Posay beauty. So you get the mixture of a stable, very powerful grocery business and value, as well as a marketplace. And we like that because it's and retail. As you think about AI and supply chains and curbside pickup and LLMs, Walmart's playing there too. And it's very expensive and unprofitable. They've reached profitability with their online business. So you get the blend. You get the blend of the defense and the offense. And it's the everyday low price signature retailer. I grew up in Louisiana going to the Supercenter. and it's also a fabric of a community. So we like it for those reasons. Much more expensive. It's about 34 times PE, and Macy's is at a 9 times PE, but I think it's worth it.
Yeah, really interesting stuff, Oliver. Great to get some time with you. That is Oliver Chen. He is Managing Director of Consumer Retailing and Senior Analyst over at TD Cowen. Now coming up, American Bitcoin has made its NASDAQ debut. We'll speak with Eric Trump. He is co-founder and chief strategy officer, as well as Asher Genoot. He is executive chairman of American Bitcoin and the CEO of Hut 8 up next. This is The Close on Bloomberg.
.40 p.m. here in New York City. This is the countdown to The Close. I'm Romaine Bostick.
And I'm Katie Greifeld. We're keeping an eye on this equity market. We're also keeping an eye on shares of American Bitcoin. That is after the Bitcoin mining and accumulation platform made its debut on the NASDAQ this morning following its merger with Griffin Digital Mining. Joining us now to discuss, I'm pleased to say, we have Eric Trump. He is co-founder and chief strategy officer of American Bitcoin, as well as Asher Genoot, the executive chairman of American Bitcoin and the CEO of Hut 8. Great to have you guys with us. Eric, I'm going to start with you because there's a lot of crypto treasury companies out there at the moment. You think about Michael Saylor's strategy being the most prominent of them all. What differentiates American Bitcoin?
Well, Katie, at its core, we have a great mining business, right? Right now, we're mining Bitcoin at roughly 50 cents on the dollar to the actual price of Bitcoin. We're mining a lot of it. We're using the Hut 8 infrastructure in order to do so. And so we've got an unbelievable advantage. I mean, we've got hundreds of millions of dollars of hard assets, data centers behind us, mining operations every single day, which allows you to kind of dollar cost average down the Bitcoin that you actually do take on your balance sheet and the ones that you go out and accumulate. And so while everybody has to accumulate at par, for us, we're able to mine at a substantial discount to par, and I think that gives us an unbelievable advantage. And so, just simply put, you have probably the greatest asset in terms of appreciation over the last 10 years, averaging 60, 70% a year over year, that you're mining for a 50% discount to total value. It's a pretty simple concept to figure out. So we're incredibly excited about the debut. We have massive aspirations to be the absolute best crypto company anywhere on earth. I think you know how hard we all charge, and we're pretty known for that, and we're having a lot of fun doing this.
Well, Asher, let's talk a little bit more about Hut 8. So they, of course, provided all of the mining equipment to American Bitcoin. Give us the breakdown here. What does Hut 8 get out of this arrangement?
Hut 8 is one of the largest shareholders of American Bitcoin. So to start, we want the equity value of American Bitcoin to appreciate. Hut 8 is long infrastructure. We believe that all technologies that push humanity forward end up relying on additional consumption of energy. So how do we harness an electron and push those technologies forward, whether that be the blockchain and Bitcoin and or AI and data centers and other advanced manufacturing use cases. And so American Bitcoin helping us go long energy, develop more infrastructure is core to the Hut 8 business, where at American Bitcoin, we're long Bitcoin. And so that was something that became more and more of a hot item, where at Hut 8, we were a Bitcoin mining business, a Bitcoin treasury, and an energy business. And so we had shareholders that were long energy, shareholders were long Bitcoin, and there started to be some conflict. And so we said, hey, it's about time that we think about carving out these assets. Eric and his brother were building American data centers. We brought those efforts together and thought we could build a bigger company together. And so today we have Hut 8, that's a listed company on the NASDAQ, and American Bitcoin that's making its public debut on the NASDAQ as well. Both companies are extremely synergistic, and what allows them to be successful is the relationship that they have that allows each of those businesses to be long Bitcoin or long energy together synergistically.
I am curious, Asher, on the mining side of it, what do the economics actually look like in that space? I mean, we talk so much about it being energy intensive, but the ROI on that, of course, is not quite what it was a few years ago when people were first kind of discovering this space. What does it look like now?
That's right. Our cost to mine a Bitcoin was about a 50% discount to the market. So all-in cost of energy was around $37,000 a coin. All-in costs on a cash basis, including operations management, was around $58,000 a coin. And so extremely competitive. And the reason we're able to do so is the site that we just built, for example, in Amarillo, Texas, we're behind the meter at a 205 megawatt wind farm. So we're directly connected into the wind farm at low cost power. We're connected into the grid as well. We're very good on trading around energy dynamics. And so the way to win in mining today is to be able to control your energy costs, but also be able to have efficient cost of capital. And by combining these two businesses in one strategic partnership, we're able to do so. And so I think historically, people invested in mining companies or people are investing in treasury companies, and the focuses of these businesses are on growth at all costs, where American Bitcoin is focused on Bitcoin accumulation and increasing Bitcoin per share. We will only invest in mining when it is profitable, and we will only raise capital to buy Bitcoin when it is accretive. Otherwise, we'll pause and be able to have a multi-pronged strategy in order to grow Bitcoin appreciation.
So, Eric, when it comes to that accumulation strategy, right now, are you looking primarily for that accumulation to come through the existing coins that are out there now, or is a good chunk of that actually going to come from some of the mining operations?
Well, whichever is better at the time, right? I mean, we have both strategies, and we're going to implement those two strategies well. There's only a certain amount of Bitcoin that can be mined every day, and we're going to harness that to the absolute fullest. And we've got the best facilities. You ought to see them. They're absolutely incredible. They're technological masterpieces. At the same time, we can be creative. We can go out and we can purchase Bitcoin, hold it on the treasury, and again allow the mining to dollar cost average down. And so we're going to be implementing both strategies. Whichever is best for shareholder value is obviously what we're going to prioritize. And again, we're sprinting at this with the mission to win. Everybody right now, all around the world, wants the asset, wants Bitcoin. You see it from the largest Fortune 500 companies to the biggest sovereign wealth funds to nation states to states here in the United States, right? I mean, Texas, you saw what they just did, and obviously Wyoming, and it's really the hot asset of our time. It's an unbelievable store of value. It's doing it better than anyone, and we're going to win the race.
I am curious, though, Eric, in terms of the business strategy itself, I mean, how much do you plan to use leverage, meaning debt financing or other types of financing, to make these purchases? As we know, particularly with strategy, which everyone sort of looks to as the pillar in this, a big part of their success, certainly in terms of their stock, has been Michael Saylor's creative use of financing.
Yeah, key here is being able to manage through bull and bear markets. We've lived through many bear markets, and the companies that are able to survive through those, they get larger, they get bigger. And so being conservative, being risk-focused on how do we grow in a conservative manner where we're able to manage through any bear markets, any pull down in Bitcoin price is critical. And so as we think about leverage, where our main focus primarily is equity, but as we think about leverage, looking at our debt to equity ratios, making sure we can sustain large pull downs in Bitcoin, where we have the reserves to be able to pay those down, that is all key and critical. In 2022, I saw everyone around us going bankrupt, from FTX to Celsius to other mining companies, and that's really stuck with us. We grew much larger during that period of time, and as we build American Bitcoin, the key for our shareholders to trust us is to be able to manage through the good times and through the bad times, and fast forward 5 or 10 years, we continue to increase their Bitcoin per share and the amount of Bitcoin that they own, and so we will always be risk-focused.
Yeah, there were certainly a lot of hard lessons learned in 2022 across asset classes, not just in crypto. But Asher, my understanding is right now American Bitcoin has stockpiled about 2,400 Bitcoin. Do you have a near-term target that you're trying or would like to reach?
Look, we launched the company a little over 5 months ago. I think from start of company to public listing, probably a record somewhere there. We've publicly disclosed over 2,000 Bitcoin thus far. We're continuing to accumulate past those public disclosures. And so we look to be one of the largest. When we started this with Eric and Don Jr., there's a very key focus. Let's build the premier Bitcoin company of the world, and we are aiming and we will do so.
And Eric, I want to talk about what this means for you personally as well, because my understanding is you own about 7.5% of American Bitcoin. Bloomberg estimates that that stake is worth about $600 million today. Would you say that this is the most valuable asset that you own at this point?
Katie, we're incredibly fortunate people. I mean, you know what I've done my entire career. I've built some of the greatest buildings on earth. We have one of the greatest property portfolios anywhere. I want to do things that are creative. I want to do things that are great for humanity. I really believe that we're on the forefront of kind of this, financial revolution. I got into this business, digital assets. I would have never gotten into it had we not been, debanked like dogs, just simply because of, the political standpoint of a father who was running for political office. And And I found some of the greatest people in the industry that you've ever met, some of the smartest people that you've ever met, with one of the greatest products that you've ever seen. And honestly, I want to bring it to the masses. I want to be a great spokesperson for it. And listen, we're incredibly fortunate in life with or without this endeavor, but we want to win. Anything we do, we want to sprint at very hard. And again, I believe in Bitcoin. I've been a long-term owner of Bitcoin. I've been buying it for several years at this point. And I see its adoption all over the world, and how much it's being embraced globally, and the floodgates are just starting to open, and so it's kind of perfect time. So we're just really excited. I'm excited about our hard assets, and I'm certainly excited about American Bitcoin. And I think you can see, based on the ticker that's been on the screen the entire time, the success we've had today. It's really been an unbelievable day and a lot of hard work that's finally come to fruition. And today is the first of many great ones to come, but we're just excited to be here, guys.
Of course, as a public company, Eric, I mean, there's obviously going to be a lot more scrutiny over the business practices, particularly given some of the criticisms, which I'm sure you're aware of, that this business venture, as well as others, are directly benefiting from your father's presidency. As you get deeper into this business with American Bitcoin, Hut 8, and others here, how do you plan to address those criticisms, whether legitimate or not?
Well, they're totally illegitimate. I got into this business because I was illegitimately debanked from every financial platform, in the country, which is not only wrong and un-American, but it's, unconstitutional. No different than we started Truth Social because my father got thrown off of Twitter. We started this business because we were deplatformed and we needed to find our own way. And it made me see this kind of great financial revolution that's ahead of us. So no, my father has nothing to do with this business. He has nothing to do with the Trump organization whatsoever. He's obviously running our country, but he's always been a proponent. In fact, I think being a proponent of cryptocurrency probably helped get him elected. He's always been one of those guys who could see the trends far in front of him, and he knew China was pursuing it. He knew the Middle East was pursuing it. He knew every other country around the world was going to pursue it, and he wanted to win this battle for America. And I plan on doing something totally, obviously separate and distinct, but I plan on doing the exact same thing.
All right, Eric, really appreciate you taking time for us. You too, Asher. Eric Trump there, the co-founder and chief strategy officer over at American Bitcoin. Asher Genoot is the executive chairman, and he's also the CEO of Hut 8, and we keep an eye on ABTC, the new ticker there. At one point, the shares did actually double on the day, but now only up a mere 18% here on the day. I know.
Yeah, I wouldn't say no, nor too would plenty of the bulls out there. Let's take a look at these equity markets right now. Less than 10 minutes until the close. You can see actually the rally coming back to life a little bit. The S&P 500 now up 0.4%. You can see once again, it's big tech leading the way higher. The NASDAQ 100 higher by about 0.7%. The bond market, you're seeing a little bit of a rally today at the long end of the curve, down about 4 basis points on the 10-year Treasury yield, and Bitcoin also higher
Bitcoin.
on the day.
We were just talking about that. I hate to throw cold water on your rebound story, but we should point out too, Apple and Alphabet are really leading the charge here. And without those two names and the big pop we're seeing there, 9% on Alphabet, 4% on Apple right now, we would actually maybe be in the red on the S&P and the NASDAQ. As we count you down to those closing bells, Mo Haghbin comes into the studio, head of strategic ETFs over at Proshares. And Mo, we started off this show talking about ETF flows and kind of what they're telling us. Seems there's still momentum in equity, a lot more momentum when it comes to fixed income. What are you seeing?
Yeah, look, I think the year has been actually quite strong with flows. Earlier in the year, we saw a tremendous amount of risk-taking in equities. April obviously was a big drawdown month, so there was defensiveness, there was hedging, but then that was a very quick rebound. So I think for the full year, we expect record flows. We've also seen record launches, a lot of innovation happening in the space. So really, really good story, and I think we're optimistic going into the year end.
What do you think investors care about most? I mean, there's been so much hand-wringing, obviously, in the start of the year over what's been going on with tariffs and trade policy. The attention then seemed to shift to the Fed and rate cuts. Are people more interested in what comes next when it comes to the economy and the Fed, or are they still just focused on geopolitical issues, or are they just focused on the bottom line of corporate America?
Yeah, look, when I'm talking to clients, what we hear most often is tariff uncertainty, and I think the legal challenges and the legality of tariffs now are front and center. But there's also this lingering inflation conversation, and I don't know if we're talking enough about that. Everyone's expecting a pretty accommodative Fed, and I think we will get rate cuts, but how aggressive is that going to be? And are there other factors at play that keep inflation a little stickier and a little higher that would put the Fed in a situation where they're uncomfortable cutting aggressively. I think we all would agree that rates should be lower, but how much lower is a really good question. And I don't know if inflation has really, we haven't seen the end of that story. I think we'll hear more about it. And this week, actually, Friday, payrolls will be an interesting number to watch.
Especially after what we learned from the JOLTS report this morning. I want to bring this conversation to gold, though, because these questions that we're having over inflation, what the Fed is going to do, whether and by how much they're going to lower interest rates, gold has been on a tear. You've seen a lot of money being poured into the ETF space going into gold. Is this sustainable? Is this the answer for a lot of investors who are worried about inflation?
Yeah, it's an interesting asset class. I spent many years in the multi-asset space and thinking about asset allocation decisions. Gold was always a tricky one because it doesn't have like a yield. It's not really something where the fundamentals support it. It's more of a tactical or kind of supply-demand type trade. But no doubt, performance has been very, very strong. And I think there's two ways of thinking about that. One is defensiveness, right? I do think it serves as a ballast and diversifier in the portfolio, and markets have been uncertain and, quite frankly, valuations a bit stretched on the equity side. The other way of thinking about it is it's a little bit of a vote of confidence around the fiscal situation and debt and really the oversupply of debt. And is that a way to kind of get diversification similar to Bitcoin, right?
Similar to Bitcoin. Well, let's talk a little bit more about Bitcoin. Definitely one of the themes of today. I mean, the things that you're talking about, the pitch that you could make and build for gold right now, can you actually apply that to Bitcoin, or is it in its own world?
I think of it in its own world, but there has been a maturity and a much more institutional conversation around Bitcoin, which I think is notable. We're hearing a lot from clients around asset allocation and how to incorporate it into the portfolio. And when you think about the market cap of Bitcoin, it now represents over 1% of all investable assets from a market cap standpoint. So it's hard to ignore. And I think it's an important conversation. I would think of it more as a diversifier. And we've seen the volatility of Bitcoin come down pretty substantially over time. Yeah. So the use cases, I think, are starting to become a bit more relevant for clients.
All right, Mo Haghbin is head of strategic ETFs over at Proshares, counting us down to the closing bell. Some breaking news crossing the wire right now on Apple. Bloomberg is reporting that Apple plans an AI-powered web search tool for its Siri platform, which it says could potentially rival OpenAI. We've actually had a lot of headlines here in the AI space over the last, a new funding round for OpenAI that would potentially value it at $500 billion, a new funding round for Mistral that would value it at $14 billion, and now Apple. Maybe apparently trying to get its mojo back on the AI.
This is an interesting one because Apple, the narrative that has been haunting them is that they're behind in AI, but getting a little bit more detail here. They plan to roll out this AI search feature in Siri in the next year. Rather, they're also going to evaluate the Gemini model for new Siri. You can see that's helping out shares a little bit, already up on the day, though.
And we should point out this reporting coming from Bloomberg reporter Mark Gurman, who spoke to people familiar with the situation, still trying to confirm all of the details with Apple itself. The share is up about 3.7% as we get closer to the close, but we should point out they were already higher on the day here, so not much of a movement on the back of the headline, but a full breakdown of what just happened there, a full breakdown of what just happened during the trading day, and a push ahead to some big earnings out of Salesforce and Figma.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Katie Greifeld taking you through to that closing bell with the global simulcast. We're joined right now by Carol Masser and Tim Stenovic in the radio booth. Welcome to our audiences across all of our Bloomberg platforms here on a Wednesday afternoon with financial markets, equity markets trying to claw back some of the losses from yesterday. Carol.
Yeah, what an interesting trade. It feels like it's been under pressure so much of the day. And then here we are, in the last hour or so of trading that we've seen investors moving back into the market. And so we are definitely, as you mentioned, Romaine, off our lows of this session and the most outperformance you're seeing in some of those big tech names.
Well,
welcome back, Carol, by the way.
Hey, welcome back to you. Thank you.
Oh, this is your first moment back.
Yeah, I haven't seen her in like 3 weeks.
Okay, the gang is all back together. If we take a look at what actually is moving the market higher, you can see the NASDAQ there. It's outperforming the S&P 500 and Katie's favorite, the Dow. Apple and Google alone adding about 30 points to the S&P 500, just those two companies and the surges that we're seeing there.
Nothing like a price-weighted index to really tell you the whole story of what's going on in the market.
You're talking about the Dow, by the way. I was talking about the S&P
yeah.
500 and the
Well,
points.
I was talking about the Dow.
Okay.
Yeah, for the first time in a while.
Yeah. Well, speaking of the Dow, since you love it so much, Katie, Salesforce scheduled to report earnings after the bell tonight. We're also going to get some earnings out of Figma, which I'm interested in. Obviously, I think it's like the third best performing IPO of the year, second biggest IPO of the year here. Now has to put its cards on the table. Those shares looks like they're going to close higher by about 4% here on the day. But as Tim was just saying here, today, at least when it comes to the broader market, this was all about Apple and Alphabet. That's helping to push the NASDAQ up about 1% on the day, or more than 200 points. Takes a while for these numbers to settle, but definitely a day where it's going to end in the green. The S&P 500 up more than 30 points, or 0.5% on the day. The Dow Jones Industrial Average sitting this one out, down more than 20 points, or a fraction of a percent on the day. And let's take a look at the Russell 2000. Well, an index I guess a lot of people forgot about on the day, down about 2 points, or 0.1%.
All right, digging a little bit deeper into the S&P 500, Romain, almost an even split, slightly more negative. 226 names gaining ground in today's session. 276, Katie, to the downside, one unchanged.
Let's take a look at the sector level as well. There was more red than green, but the green that was pretty notable. You had communication services as a sector higher by 3.8%. That is thanks in a big way to Alphabet. You also had the tech sector rallying as well. That's probably thanks to Apple. Consumer discretionary also in the green, as too was staples just slightly. What didn't do too hot today, energy down in a big way, as too was the industrial sector.
All right, guys, let's get to some of the individual gainers as we await a batch of earnings. Top of mind is certainly Alphabet, but let's go to Salesforce because they're breaking.
Yeah, Salesforce right now, the ticker CRM, and you're seeing a big move in the shares here in the after-hours trade. The company says the second quarter sales did come in at about $2.27 billion. That's only a smidge of what the street was expecting. 2.24 was the average of analyst estimates. The bottom line number, EPS, $2.91 a share. That's up from $2.56 in the year-ago period. I need to take a closer look to get you how that compares to the average of analyst estimates. But here's your guidance going forward. For the current quarter, the company says 3Q revenue, $10.24 billion to $10.29 billion. The street, on average, was looking for $10.29 billion. So the top end of that range, just meeting the average of analyst estimates. And for the full year, guys, $41.1 to $41.3 billion. That is slightly higher than its previous estimates, or at least the low end of 41.0 to 41.3. So it looks like it met the most recent estimates for the second quarter, but it looks like for the third quarter and for the full year, guiding relatively in line with estimates with a slight bias to the downside.
Yeah, the stock's been under pressure this year, and investors still not impressed. The stock's down about 5% here in the aftermarket. Looking at Mark Benioff, the chair, CEO of Salesforce, saying we delivered an outstanding quarter to close out the first half of the year. Strong performance across revenue, margin, cash flow. He says he remains on track for fiscal 2026 to be a record year with nearly $15 billion in operating cash flow. But, we talked to Anurag Rana, who covers this company for our BI, and he says, part of it is, they kind of need a little bit of a catalyst that a lot of people in terms of their enterprise software spending already have done it. And so maybe it's not until 2026 that we start to see some numbers move in here. Oh, back to gainers. Sorry. Let's go back to gainers. All right. So we're going to continue to watch Salesforce, as we mentioned, under pressure here in the aftermarket. As I mentioned, Alphabet, that was definitely an outperformer, a top name in the S&P and the NASDAQ 100, a gain of about 9% in today's session. The story broke late yesterday. U.S. antitrust ruling, not as severe as feared. Google will be required to share online search data. But the big thing is they're not going to be forced to sell off its Chrome business. So definitely saw investors move into that one. Another kind of offshoot of that ruling that benefit is a company named Opera. OPRA is the ticker. That stock was up almost 11% in today's session. It's a web browser company. They've got a partnership with Google. And so this company definitely benefiting as well. B. Riley saying it sees incremental positives for Opera given the likelihood of status quo for their Opera Google search partnership over the medium term. So we definitely saw investors move into some different names as a result of that ruling. Got to mention Macy's up 20% in today's session. Owner of Bloomingdale's and Bluemercury as well. Jumping after the company reported adjusted earnings per share for the second quarter that beat estimates, and they boosted their forecast for the full year. Also posted the best comp sales growth in 3 years. did warn of a fickle consumer. And I'm going to skip my last one because I feel like I've talked enough today.
Yeah.
No, Carol, you're doing great. But you know what? If you want me to do decliners,
I like this new Carol. She's like just turned over a new leaf.
This is what 2 weeks of vacation does, right? Yes. Hey, I want to start out with three stocks that are in the S&P 500 that led the declines today. Intuitive Surgical, ISRG, down 6% today. Shares tumbled intraday to their lowest level since April after executives of the company gave cautious comments during a presentation at the Wells Fargo Healthcare Conference earlier. You know them. They make the Da Vinci surgical robot that is used worldwide. The company's CFO said during the presentation that tariff impact is expected to be higher in 2026. Also said that gross margins for 2025 will be at about 66%. The company previously said they'd be between 66 and 67%. Also saying the company is seeking greater challenges when it comes to international markets. Also, ConocoPhillips shares falling by 4.4%. The company plans to cut as much as a quarter of its global workforce amid lower crude prices and expectations of peaking shale output. Katie, head on over to Hewlett-Packard Enterprise because they're out with earnings.
Yeah, absolutely. HPE is your ticker here. Here is a redhead on the Bloomberg terminal. Fourth quarter adjusted EPS, 56 cents to 60 cents. The estimate had been for 59 cents. So you can see a range there being met with disappointment. Shares currently off about 4%, rather. They also see their full year free cash flow about $700 million. They had seen about $1 billion. The estimate had been for $1.3 billion. So a few different things to pick out here. I will say the third quarter adjusted EPS came in at 44 cents. The estimate had been for 43 cents, but it's that fourth quarter outlook that seems to be sinking shares in the after hours right now, Carol.
Got another one sinking in the after hours. We're talking about GitLab. It's down about 3% here in the aftermarket. Let's go right to the outlook. The company still sees fiscal year revenue of about $936 million to $942 million. The street estimate was for $940 million. So maybe there's some concerns about a little bit of a wide gap, if you will, and maybe a little bit more to the downside. GitLab sees third quarter revenue of $238 to $239 million. The street estimate is $241.5 million. So that for the third quarter is below what the street's been expecting. And then let's go back to what happened in the second quarter. Second quarter adjusted EPS, 24 cents a share, folks. That's a beat of about 8 cents a share. And then GitLab second quarter revenue, $236 million, also a beat. $227.4 million, but you can see remain big hit in the aftermarket.
And I just want to point out, too, because that Salesforce is actually dragging down a lot of the other software stocks.
Point.
And there was a lot of concern coming into this earnings season about the durability in that space. We're getting earnings out of Asana and PagerDuty, and we're awaiting earnings out of Figma, which, of course, had been the darling. I should just point out those shares now down 8% in the after-hours trade, though they have not reported results just yet. We're still waiting on them.
I'm watching American Eagle Outfitters shares. They're surging in the after hours, up 9% as we speak. The company out with second quarter net revenue that did beat estimates. The company also noting that net revenue coming in at $1.28 billion. That was beating estimates of $1.23 billion. Total stores came in above estimates at 1,185. Also some commentary about recent high-profile ad campaigns.
Who?
Yeah, from American Eagle, the fall season is off to a positive start, fueled by stronger product offerings and the success of recent marketing campaigns with Sydney Sweeney and Travis Kelce. We've seen an uptick in consumer awareness, engagement, and comp sales.
It's all about the good genes, right?
That's what the ad said.
All news is good news.
Yeah, I guess so.
Shares higher in the after hours.
All right, that one's rallying. HPE down about 2%, and I'm looking at Salesforce down about 4.5% here in the aftermarket. All right, guys, that's a wrap. Our cross-platform radio, TV, YouTube, Bloomberg Originals. Katie and Romain continuing there on the close on Bloomberg Television. Tim and I continuing right here on Bloomberg Business Week Daily. We'll see you again, same time, same place tomorrow.
We continue our coverage here on Bloomberg Television with a close focus on some of those earnings coming down the wire, particularly from Salesforce and Figma. Earnings, of course, that all center around the progress in the AI space. We got a scoop just before the closing bell on Apple that apparently they're now trying to articulate a little bit more of a presence in that space. Plans to create an AI-powered web search tool for Siri to rival OpenAI. Mark Gurman broke that story for us here at Bloomberg, and he joins us right now to talk a little bit more about this. When should I expect to see this, if at all?
March 2026.
Okay.
That's when the big Siri overhaul is finally coming to market. It was supposed to come out a year ago, a little over a year or less than a year ago. Now it's going to come out in spring 2026. some features. One, these are announced, the ones I'm about to list. Voice-based navigation, control your phone and your devices all with your voice.
Okay.
Scroll here, like this, screenshot that, etc. The other thing, deep search into your device to pull up files, text messages, songs, etc. Right, I can say, what song did Romain text me last week? And by the way, you should text me, because this is just an example. And it'll be able to do that. Shocking, it can't do that already.
Yeah.
The third thing is take action on what's on my screen right now. The fourth thing, that's what we're breaking the news on today. They haven't announced this yet. There's going to be an AI-based web search product within Siri competing with ChatGPT and Perplexity. If you're like me, I don't go to Google search anymore. I open ChatGPT to search it. Now, for the first time, Siri will be able to get you detailed results from the web using its own technology. And it's also working with third parties, likely to work with Google. Right, that's who they're leaning towards right now. Google,
that's timely.
Yes, Google has created a custom Gemini model for Apple. They delivered it to them this week. They reached an agreement for Apple to evaluate that model towards making its decision. Also in the running is Anthropic, and it's also considering its internal models, but Google's at the forefront of the search right now for an AI partner. Right, I teased an AI partnership on the shows earlier, but this is the AI partner I was talking about. And if they get this done, there is huge potential for Apple and AI.
Yeah, it's interesting. So first of all, this is called World Knowledge Answers. Right?
Internally, that's not going to be the
I hope
official
something
name.
A little smoother.
It's a mouthful. No, it's not going to play.
Okay, so some feedback there. Talk to us, though, about the potential partnership with Google and what this says about Apple working with third parties, not doing this necessarily all in-house.
Apple's bet right now is that these AI models, the generative AI models, large language models, the foundation models, whatever you want to call it, at the forefront of AI are going to become commoditized, right? And if they become commoditized, they don't necessarily need to have that top-tier technology internally. So they're looking for acquisitions, they're looking to replenish their pipeline of talent, and they're looking for deals in order to bring it in-house. Customers, they do not care where the AI technology is coming from as long as it works. And so from that standpoint, if Apple gets these deals done, they're in good shape.
Just finally, I mean, Apple has a big event planned for next week.
I've heard a few things.
I've heard. Do you think they're going to articulate? No.
I don't think maybe they'll try to spin some of the new features they're announcing next week, maybe stuff related to the camera as AI features, but they've got nothing really AI related. In terms of the AI that we're talking about and thinking about next week, that's a next year thing. Next year they'll have their big smart home launch, and they'll have their big Siri revamp, and then in the fall they'll have some more Siri features. There's going to be a visually redesigned version of Siri at the end of 26 as well. So a lot in the AI pipeline when it comes to Apple in terms of both software and hardware.
All right, Mark Gurman, of course, has his finger on the pulse of all of this stuff. A breaking story on the Bloomberg terminal about Apple's plans for an AI-powered web search tool for Siri to rival OpenAI in partnership with Google and Gemini.
Yeah, interesting to see that news. We do have some more earning news to bring you. This coming from Figma, one of the hottest IPOs of the year, getting these numbers now. Second quarter revenue coming in a hair below $250 million. That is up 41% year over year. Full year revenue coming in between $1.02 billion to $1.03 billion. And third quarter revenue coming in between $263 million to $265 million. You can see shares are getting crushed in the after hours right now. Figma shares down almost 12%, but a very, very high bar, Romain, just coming off of share performance up over 100% since the IPO.
Well, C3 AI shares not doing much better. The ticker AI, and they're down about 10 to 11% in the after-hours trade after releasing its own earnings. Of course, the headline here is a subscription miss when it comes to subscription revenue in its fiscal first quarter here. We should also point out that company said that subscription revenue was down 18%, $60.3 million in the most recent quarter at a time. Of course, when most investors, particularly in the AI space, are looking for growth. We're also learning now that the company has named a new CEO. We're going to try to get you some information on that as well. So a lot going on in the AI space with Figma, C3 AI, and of course, we heard just a little while ago from Salesforce. Doug Clinton joins us right now. He's the CEO and founder at Intelligent Alpha, and he's been all over what's been going on in the tech and AI space. Doug, I'm not quite sure where to start here. Kind of a mixed bag. We're not really seeing any of these companies sort of fall off the cliff in terms of their businesses, but certainly those high growth rates that investors had been looking for, at least for the most recent quarter, not there.
Talk about an ugly earnings period, Romaine. I think we're 5 for 5 in the red right here. And I think this is actually symptomatic of maybe a little bit of a shift that we've sort of been expecting and watching for in the market, which is post-Liberation Day, we had this sort of torrid rally in AI stocks in particular. Some of these names were up 50, 100% in just a few months. And now I feel like we're in this period, and we've kind of been expecting this, as I mentioned, where we need a little bit of digestion in the AI trade. I don't think the AI trade is over, far from it. I still think we have several years left in this current AI bull market. But I do think we're at a period now where unless your earnings are perfect, maybe even better than perfect, you're going to get hit a little bit when you post numbers like several of these companies did today.
I am curious, though, about that, Doug, this idea of sort of what investors want. And I understand, obviously, ultimately they want a higher ROI, but it gets to this idea of what constitutes an AI company. Do they need to be making something that's unique, something that can't be touched? I've heard a lot of discussions about how software is falling out of favor. People are looking more towards hardware and devices, things that are just going to be a little bit harder for competitors to replicate.
I think for the hyperscalers, for the hardware companies, as you mentioned, I think it's clear who is and isn't playing in the AI space. If you're selling chips, right, that run inference or do training like NVIDIA, like AMD, you're an AI company. If you're building models like Google, maybe even now Apple, like Mark just described, you're an AI company. But I think when you're in this software sort of gray area, it's not as clear. And I think that that's been a lot of the challenging reality for software. Beginning of the year, I mean, Salesforce is down double digits, Adobe's down double digits. A lot of these really high-end software names have not been able to get attached to an AI story. And I think fundamentally the challenge is this. All of them are developing AI products. They're talking about AI products all during their earnings calls, but they're really not seeing the revenue traction that we are seeing at the hardware companies, and that in many cases we are seeing at the hyperscalers too. They just need to show some real revenue, and it's not happening yet.
Doug, I want to get specific here, and I want to talk specifically about Figma. I said it was one of the hottest IPOs of the year. I don't think that is a very controversial statement. You can see the shares after hours really taking a beating in their first earnings report since that IPO. You write in your notes that the first rule is that you have to beat and raise your first time out of the gate. These numbers weren't so bad. I mean, it was a 41% jump in revenue, but it's not getting rewarded right now.
Just not enough. When you have an opening like Figma did, and your stock is up 100% on the first day, and you haven't really pulled all the way back from that, I think that just sort of adjusts the bar. And one of the things that's also challenging for new IPOs like a Figma, Katie, is that when they go public, right, you only have a very limited float out in the public, and so 10% is your average. And when you get earnings and sort of some of these really dynamic, idiosyncratic events, things are maybe more choppy than are realistic relative to the business. And so to your point, I think Figma is actually a great business. I think they've had really incredible growth. I think in the long run, it's probably a stock people should pay attention to. In the short run, it will be choppy because of that limited float, and because investors, I think, are still playing this a little bit more like an IPO trade than an investment.
Well, to that point, I want to speak to you as an investor. You manage the Intelligent Livermore ETF, the ticker there, LIVR. I don't see Figma among your 70 or so holdings. How do you approach these very hot IPOs? Do you want to give them time to season, or is this something that you're trying to get your hands on as soon as possible?
We're open to investing at any time. And Katie, what we actually do at Intelligent Alpha is we use AI to evaluate thousands of stocks in the various funds that we run. And Figma is in the universes of many of our different strategies. It hasn't actually been one that I've seen come across the 30 or so different strategies that we manage. And so whether it's something about valuation, whether it's something about the long-term prospects of Figma, our models just haven't been hot on it yet. With today's correction, maybe that will change the minds of our AI.
All right, well, that's a good place to leave it. Doug, great to get some time with you. That is Doug Clinton. He is the CEO and founder over at Intelligent Alpha.
Just point out, C3AI, Figma, GitLab, all basically down almost double-digit percentages. You know what the best performing stock in the after-hours trade is?
I was hoping you'd tell me.
Jeans.
Jeans. American Eagle.
American Eagle, 25% pop.
Good genes. Yeah. American Eagle, though, shares down 21% going into this report, so some good news there. But coming up, we're going back to tech because Apple, as we discussed, planning to launch its own AI-powered search tool. We'll discuss next with Mountain CEO Mark Douglas. This is The Close on Bloomberg. Well, back to that Bloomberg News scoop that Apple is planning to create an AI-powered web search tool for Siri to rival OpenAI. Apple shares finished the day higher. Let's discuss with Mark Douglas. He is CEO at the advertising software platform Mountain. Mark, great to see you on set. So, of course, this is good news, theoretically, for Apple planning this. A pessimist might say that it's amazing that they don't already have this.
Well, I would tend to agree with that. And the way I think about this is that they have no choice. OpenAI literally has Johnny Ives, who designed the iPhone, as part of their company, working on a competing device. I think everyone's always a little wary of partnering up with Google and becoming dependent on Google, so Apple has no choice. But Apple also doesn't have a great track record on execution. And name a new product from Apple that you're like, oh, I loved it when it came out. And so just because they announced it doesn't mean we're going to see something great, especially given the competitors.
Well, I loved the iPhone, from back
That was big.
That was big. There you go.
I mean, you're on version 19 right now.
Yeah, a really tiny, horrible phone. It's off charging in the quarter because it can't hold a charge. Anyway, another interesting nugget, though, in this Bloomberg News scoop is that they are partnering with a third party. They're looking to work with Google here. And I hear what you're saying, that execution is a risk here. It might not happen. But the fact that they are not doing this all internally is interesting.
Well, I think that's a good point, because I think it will require partners. There are only going to be a few companies that really can build the kind of internet scale app for AI. Apple certainly has the scale to do it. I'm just not sure they have the expertise.
I mean,
and we've seen how hard it is for Meta to hire the people. To bring Apple in that mix is not going to make that easier.
Yeah, and we just had a headline earlier today, another executive from Apple jumping ship to go over there. It gets to the idea, too. I mean, we just had this court ruling, this antitrust ruling involving Google, Chrome, and just the whole idea of search. And this kind of folds into the AI space, because one thing I thought was curious about that ruling was the judge, almost to a certain extent, said, we're not going to break you up, because to a certain extent, search isn't as relevant as it was maybe, 5, 10 years. So maybe if this case was brought a while ago or had been settled a while ago, we might have seen a breakup. But I am curious. I mean, you are kind of at the forefront in how companies are reaching consumers. And I am curious, do you think AI will replace that, not just in terms of us as consumers using it, but as a way for companies and advertisers to reach those people?
Well, certainly already starting to play a big role, right? Both in terms of strategy, literally identifying the right consumer for the product. That's something we work on a lot at Mountain. Creative, another area. So it's across everything. To even use the phrase AI is almost going to, I think, seem pedestrian in the not too distant future, because it's just assumed. So it is going to play a big role.
I'm going to ask you a very loaded question, but how do we not ruin AI the same way we ruin search? Because part of the reason why search seemed to decline is because the quality of what you were getting seemed to go down. It was either ads, or it was people who learned how to game the SEO system to put whatever junk at the top of the search results. And one reason why I gravitated to Perplexity and some of those things is the quality of what I'm getting was just so much better than when I've used regular search.
Well, the way to do that is open source, is to keep as many ways of getting AI results and interact with AI to help you in whatever you're doing as possible. And so right now we have already this concentration of these incredibly funded companies, obviously Google, OpenAI, and others, is we have to make, when I say we, I think the U.S. government, I think governments around the world should encourage AI development among, open source and things like that. And some of the best models out there are open source, but they're just not as easily accessible to consumers. What the judge did in his ruling, maybe they can pre-mortem what could happen. You see what I mean? That $20 billion doesn't buy you the best placement. Maybe that's a way to do it.
Well, this specific ruling, I mean, there's obviously some nuances here, some idiosyncrasy. I can't say that word. Anyway, there's some specifics to Google here. But do you think that you can extrapolate this out to some of the other big tech companies that are coming under regulatory scrutiny right now?
Not really. I think Google it was just in such a unique position. They literally the second player to Pioneer Search, but they obviously dominated it, and got a position and were very aggressive about building and maintaining that position. I think the thing in AI is that it's incredibly competitive. Google was years in before I think people realized what kind of scale they had. OpenAI had 90 days before they already had competition, and so it's an incredibly competitive arena. And I think and I hope it's going to remain that way. Absolutely.
You think it is going to remain?
I think it will. I just don't want it to be only among the biggest players, that it's only the biggest tech companies. I think there's a lot of innovation that can come from a lot of different.
But you don't see it going. I mean, at some point, search was a competitive business, and then it was basically Google.
Yeah, I don't see. I don't see it going in that same arena. I see it already right now in terms of my usage and other people. It's like I use Grok for some things. I use ChatGPT for others. I use VO for they each seem to be good at different areas. And I don't think that all these companies are going to stop investing where one gets a big advantage over another.
All right, Mark, always great insights. Mark Douglas there, the CEO over at Mountains. Quick breaking news here. Harvard, of course, which had its funding frozen by the Trump administration, that $2 billion funding freeze has now been deemed illegal by a U.S. judge. Once again, the U.S. government is said to have violated Harvard's free speech rights and didn't follow proper procedures when it suspended that $2 billion in federal funding. Let's take a look back in history to today, the birth of eBay, September 3rd, 1995, when Pierre Omidyar launched a website called Auction Web, selling a laser pointer, and a broken laser pointer at that, $14.83. But it actually started a revolution. At the time, Auction Web was largely a hobby, but Omidyar eventually realized he was onto something and formalized the business under the name Echo Bay Technology Group. In a little more than a year, it processed at least 200,000 auctions, and by 1997, decided to shorten its name to eBay. It was good timing. The company's ascent parallel to the broader boom in e-commerce, and in 1998, supercharged by an out-of-the-blue collectible craze for Beanie Babies. The stuffed toy collectibles became a hot and scarce commodity, with lucky purchasers quickly turning to eBay to flip them for instant profits. The company would eventually evolve from that, auctioning off a wide variety of items like clothing and car parts, as well as more esoteric fare, like the sale of the privately owned town of Bridgeville, California, a one-on-one lunch with Warren Buffett, and a half-eaten piece of French toast that Justin Timberlake was said to have left behind at a radio station. That went for $1,000. Now, the company has seen some troubles. In the 20-teens, sales growth did slow, profitability did vanish, and activist investors did circle. But over the past 5 years, eBay has found its footing under the leadership of Jamie Lannone. Since he took over in 2020, the shares have almost tripled to a record high just last month. Listings on the platform, they've surpassed $2 billion, and gross merchandise volume is now scraping $80 billion. I had a chance to catch up with Lannone earlier today to ask what the next 30 years of eBay will look like. Here's what he had to say.
We're really actually focused on re-commerce, on non-new and seasoned items, so which is very differentiated, really unlocking all the inventory that's sitting in people's closets, garages, houses, et cetera. It's the majority of our business. We have a lot of C2C sellers on the platform, consumer sellers that sell everyday items out of their house and give products a second and third life, and really being that home of sustainability. I think the other thing that people should know about is just our use of AI and technology is really exciting. We're able to get so much more product now listed because we can use AI to basically recognize the product, write the description for you, put it on a beautiful background. So we're really leaning into AI-based technologies to unlock all of the great inventory that's sitting in people's homes.
So give me an example of how that would work. If I had a baseball card or some collectible, I don't know, Labubu, maybe they'll be a collectibles at some point. I mean, what does the AI tool do for me as a potential seller?
Yeah, so, but before, if you had, let's say, a Steph Curry rookie card, you'd have to type it all in, the title, write a description, fill in all the fields of, this is a rookie card, it's a Prism card, et cetera. Now AI does all of that for you. So it'll basically, you just hold your camera up to it. You can actually hold your camera up to multiple things, and it'll actually figure out exactly what that card is, write that description. We could take a picture of something on any table and put it on a beautiful mountaintop and make it look gorgeous in seconds. All of that is leveraging kind of the AI technologies that we're building.
What was the cost to start building that out?
You know, what's been great is we've been using AI for a very long time. You know, we have 2.4 billion listings on the platform. So you can't run search and recommendations without using AI. So what I think a lot of investors have said is that it's been impressive how much AI we've put into the business without changing the financial model. We still run 4 to 5% of CapEx. So we've been able to do it really smartly. We build a lot of our own open source and proprietary LLMs that really lean in and build us advanced technology, leveraging 30 years of great data.
Does that help the buyer with regards to discoverability? I know that there's always been some reticence among some people saying that it's hard to find exactly what I want on eBay. It's just so vast. You talk about 2.4 billion listings. How does AI, how does the technology maybe make that process easier?
Yeah, it really helps because now we really know what a product is. So our ability to help get you to the exact right product faster is better. The second thing is that we're using it in our recommendation technology. So you can save your sizes. We know your styles. We actually have a product called Shop the Look to show off looks that a given customer may want to see on the platform. And so it's really changed the browsing experience. You know, now you can have an endless feed of fashion items that you want to see, all styled based on you using AI-based recommendations.
Talk about fashion, because this was something that kind of came to my attention maybe a couple of years ago about this push into fashion and how much certain people rely on it. And I even think I remember seeing the singer, I think it was Chapel Rowan, who apparently went to the Met Gala in items that she bought eBay. What's that all about?
Yeah, we're really leaning into pre-loved fashion because the younger generation is very into sustainability and the planet and thrifting and pre-loved. And so, you know, we have a lot of pre-loved fashion on the marketplace. We do over $10 billion in fashion. And so leaning in to make that easier. In addition, on the high-end fashion side, think, you know, handbags and watches and jewelry, et cetera. We've been building authentication. So this quarter alone, we authenticated 1 million items. We hit our 15 millionth authenticated item. And so the experience you have is really fantastic when you shop on the marketplace because it comes wrapped in a beautiful box. It's been authenticated by a professional. And that's built a whole new level of trust on the platform. So fashion is something we're really leaning into.
When people think of eBay, they, of course, think about collectibles. And that was obviously a big driver of the business in the early years. How much of the business is that now?
Still is. Collectibles is over $10 billion on the platform. And we've been innovating a lot. Now you can, it's very easy to get a card graded and sold onto the platform all in one step through a partnership we've done with PSA. One of the newest exciting things in collectibles is actually eBay Live. So people are doing live case breaks and live exposure of items. So what's your favorite team? You have a favorite athletic team?
Sadly, the Chicago Bears.
Okay, so if you're a Bears fan, you can actually buy that spot in eBay Live. And as a breaker is opening up cards, you'll get all those Chicago Bears cards. And people are loving it. We're seeing great growth in eBay Live. And it's a fun way for sellers to connect with buyers live and also for buyers to connect with each other over whatever their passion is. It could be coins or stamps or handbags.
What is your read right now on just the health of consumer spending? I would think a lot of the items on eBay would probably fall into the sort of discretionary category, if you will. Have you seen any impact from some of the economic concerns out there?
Yeah, you know, our business in Q2 is very strong. In the U.S., it grew 7%. Our focus categories where we're really zeroed in grew 10%. So we see a bifurcation between U.S. and international and more of a challenge macro in UK and Germany. But when you look at our consumers, eBay tends to perform and be resilient even in tougher macro times because we have used, we have amazing refurbished value. Used and refurbished are now 40% of what's on the platform, and they're going faster than new products. So think about it. If the dollar is stretched for you as a consumer, you're going to go on eBay and buy that, you know, refurbished Bluetooth headset or that refurbished laptop to save money. And because of all the work we've done in trust, you now get a 2-year warranty, a 30-day money-back guarantee. So it's really helped drive that business on eBay.
A big part of your business was reliant on certain trade policy rules, including this de minimis exemption that basically allowed folks outside of the U.S. to ship stuff into the U.S. as long as it was valued under $800. That's now dropped to $100. How much of an impact do you expect on your business?
Yeah, you know, one of the great things about eBay is we're not immune to that, but we're a more resilient platform because of the breadth of sellers and the breadth of buyers that we have out there. So we've been dealing with this for our China-based inventory since May of this year. And all of the guidance that we've given contemplated all of the changes, including the most recent news around that. And what we do as a marketplace is really help our sellers and our buyers be able to transact across borders. We've been doing that for 30 years, and now we've built new tools. We have a tool called SpeedPack, which helps you ship internationally from, say, China and Japan into the U.S. For a U.S.-based seller, we built a shipping tool called eBay International Shipping. So I could ship from here in New York to someone in Poland, but it would feel like I'm shipping to Chicago. I just ship it to Chicago, and eBay takes care of the rest, tariffs, duties, returns, et cetera. So really enabling those shipping solutions for our buyers and sellers is our key focus.
So the sellers and buyers don't necessarily have to worry about that so much. You've basically kind of greased the wheels in a way where the transaction is still relatively seamless?
Exactly, making it really easy for them. In a lot of cases, sellers have forward deployed inventory to the end market, so the de minimis change affect them less because they were already paying the applicable tariffs. So that's what we've been seeing.
That was part of my conversation with the CEO of eBay, Jamie Lannone, here on the 30th anniversary, Katie Greifeld, of the start of this company. All started with a broken laser pointer. Now you can buy clothes for Chapel Roan.
Yeah.
You can get car parts. You even said you can get luxury handbags, like used handbags.
That's true. Yeah, a lot of collectibles on eBay.
Yeah.
Really interesting discussion. Great to hear Chapel Roan mentioned.
Me too.
Let's take a look.
I'm glad you got the pronunciation right.
Yeah, I'm a huge Chapel Roan fan. I hope you're watching. Anyway, let's get to some of the after-hours movers because there are a lot of them. You can see that Salesforce up there, down 4% right now in reaction. Figma, though, is your big loser after hours, down about 10%, decimated, of course, in its first earnings report as a public company, coming off a high bar. You can see that HPE, Hewlett-Packard Enterprise, also a less than stellar reaction there to their figures, down about 2.7%. American Eagle standing out here, though, soaring up about 23% after hours. If this gain holds to tomorrow morning, it will erase its year-to-date losses. We'll have to see there. Coming up, much more. This is The Close on Bloomberg. Now, summer travel may be winding down for the vast majority, but one aviation company says the demand for their business is just ramping up. Vista is a leading global business aviation company that provides flight services worldwide through their portfolio of companies that covers all aspects of business aviation. Joining us now, I'm pleased to say we have Thomas Flohr. He is founder and chairman of Vista. Great to have you in studio with us.
Great to be here, Katie.
So Vista is the parent company of VistaJet and XO, for example. And the notes that you sent over to our producers position VistaJet in particular as a real-time macro barometer. And I love that idea. And with that in mind, what are you seeing right now when it comes to your clients and how they're feeling about things?
Well, since it's a real global company, we travel to every single continent. And when we see, shifts in trading, for example, it's directly reflected because, the wealthiest, most influential people in the world, they fly with us. They fly to the new destinations or they follow the trade that has been created. A big trend over the last 6 months has certainly been Middle East to America and vice versa with all the mega deals that have been announced. So it's that kind of like trade barometer that we see, and it's actually happening live.
But I am curious, with such high net worth individuals, corporations, et cetera, using it, do you ever really see a pullback? I mean, if there is sort of economic weakness, I mean, it's fair to say that obviously that hits lower and middle income people much harder than it would hit a high net worth individual.
Well, look, what we really see is that, so Vista, I founded Vista 21 years ago, so we've seen about every downturn over those 21 years. You actually see, if anything, an acceleration of flights needed because in a crisis, the decision makers need to go either see their clients or see their factories or see their board and shareholders, et cetera. So there's high activity levels in downturns. And our business model is a subscription business model, which is usually 3-year subscriptions. And any of those downturns is maybe 9 months, 12 months maximum. So we're never really been affected in any of those downturns.
With regards to that subscription, what is your pricing power like these days?
Well, look, our biggest competition is full aircraft ownership, and there's about 25,000 corporate jets in the world. And what corporate America, corporate rest of the world is really seeing, that a subscription is much less expensive or more efficient than just buying one airplane. And even if you buy an airplane, are you really buying the right one? from going from here to Miami, it's fine to fly a super mid. You don't need to fly a global express. But then you don't want to stop if you fly to Japan. So, with us, you just pick the airplane which is right for the mission. And then we're flying these airplanes between 1,000 and 1,500 hours per year. So there's a lot higher efficiency per hour. And that's what we can partially pass on, and the rest is our margin.
Well, let's talk about that aspect of your business model a little bit more. We were discussing in the commercial break that you own your fleet. You're not looking for other operators. You actually own the planes themselves. And with that in mind, how are you approaching that right now? Are you changing or investing in your fleet right now?
We are heavily investing in the fleet, but by owning the airplanes, what is the effect? Number one, we can control the quality. Remember, we're flying the wealthiest, most influential people in the world. They know exactly what they want, and we can cater by owning the airplanes to exactly the standards they expect. Number one. Number two, we can utilize them anywhere in the world. Think about it. If you were to buy a fraction or buy a full airplane, then you're really depending on the owner of this airplane. But if I want to fly a client to Japan and the owner of the airplane is in the US, I have to fly back empty. And that drives this inefficiency on these other business models. Whereas we have clients in Japan or somewhere on the east coast of Asia, and then the next flight goes from Japan to Mumbai. And from Mumbai, the plane might go to Abu Dhabi. So it's constantly at a higher rate occupied. And again, that drives efficiency and that drives the price level down, which we pass on.
All right. Well, this is illuminating. We have to get you back for a longer conversation about this. Obviously, most of our viewers, of course, if they're not already using a private jet, they certainly aspire to be. I aspire to one day, Katie.
Absolutely.
You know what it's like flying commercial these days? Thomas Flohr is the founder and chairman of Vista. All right, we should point out that Thomas did mention a little bit earlier all of those travels that people are taking to the Middle East. I actually had a chance to catch up with the CEO of Ethiad Airways. Of course, this is a big Abu Dhabi airline that really uses a hub model to connect everyone to Abu Dhabi, whether it's from the United States, whether it's from Europe or beyond. And they're expanding in a big way. I had a chance to catch up with him a little bit earlier today. He talked about his growing fleet. He talked about expansion of operations in North America. And he talked about the idea that he doesn't need an IPO to fund all that. Take a listen.
Yeah, we're very excited about this market. It's a market with a lot of potential. Today we have about 40 weekly flights to the US. About 2 years ago, we had only 3 destinations. Now we're going to 6. We just launched at Atlanta. We're going to launch Charlotte very soon. So Boston was 1.5 years ago, and they're doing very well. Year on year, we grew 20% in the US. So really excited about the potential of the market.
With regards to the expansion plan, I mean, I know this is a long-term plan, 10 years or so. It requires a lot of capital to fund that plan. I think originally you guys talked about $20 billion. Is there any need for you to go back to the capital markets, particularly equity markets, to raise the money you need for that?
That's exactly how we view the situation, right? I mean, we try to project the future. It's very hard to project the future. We have this $20 billion CapEx investment plan coming for the next 7 to 10 years. It's about $2 billion per year. We believe we can actually accommodate that with our own cash flow generation. Our balance sheet today is very strong. It's in a very strong position. Our leverage is about 1 times EBITDA, right? Which is a very good leverage for the industry. It's top 25% in the world in terms of how strong our balance sheet is. And cash flow is coming, right? Generating cash. So we are planning to self-fund this CapEx from our own operations.
So there's been no pressure to do an IPO anytime soon?
No, not really. I mean, the mandate that we had from the shareholder when I arrived about 3 years ago was very clear, right? I mean, deliver extraordinary customer experience and run the airline in a profitable and sustainable way so that you can self-fund it. Of course, you need to be ready for an IPO. I mean, I've done IPOs before. And IPO is just another form for you to raise capital when you need capital for growth, when you have a shareholder that is willing to get some liquidity. That's not our case today. Things may change, so that's why we want to make sure that if one day we need to IPO, we're ready to go. And I can guarantee you today that from a governance standpoint, from a storytelling standpoint, and from numbers standpoint, I mean, we just published our results, right? We could IPO today, but reality is we don't need to.
With regards to the long-term nature of this plan, this was a plan that was in place before the Trump administration took power here in the United States. Obviously, this administration has taken a different approach when it comes not only to immigration, but even any sort of foreign travel into or out of the country. Has that caused any sort of rethink in some of your expansion plans?
We are long U.S. I mean, you cannot bet against the U.S., right? It's an amazing market, more than 900 million passengers per year. I've learned through my career, right, that the more you invest in the U.S., the more returns you get. Mm-hmm. So we're long.
Talk about the customer that you have, the type of customer, and the type of experience that they want, and what exactly they're willing to pay for that.
So we're a premium carrier, right? And it's very important that people understand that we're a premium carrier. But we love to segment the plane. So we have a fare that is available for people that are willing to go right in economy, people that are willing to go in business class, people that are willing to go in first class. That is actually tailored for each and every segment. So we cater for all the customer segments, right? But what is really important is that we provide an amazing network for our customers. I mean, if you want to come from the US to Southeast Asia or to India, there is no other airline that can provide you a 17-hour flight with one stop. So if you want to go to Colombo, in Sri Lanka, if you want to go to Bangkok, if you want to go to Mumbai, if you want to go to Delhi, I mean, from New York or from Atlanta, in the future from Charlotte, I mean, we provide seamless connectivity. So in the end, what we're providing our customers is a very competitive fare, very competitive, very good service, premium service, and a network that can provide you a seamless trip.
How many planes are you looking to add per year going forward?
So we have about 100 planes today. We're going to about 110 by the end of the year. Only in July we got 5 planes, and we have 10 more to come until the end of the year. Yeah. But we're going to be adding about 20 planes per year for the next 5 years. So we're going to double the fleet. Ethiad, about 3 years ago, we had about 70 planes, and we're doing 10 million passengers. In 2 years and a half, we got to 20 million passengers per year. We're going to double the airline again, but now not in 2 years and a half, 3 years, but in about 4 to 5 years. And to do that, we're going to go from 100 planes to 200 planes.
Antonoaldo Neves there, the CEO of Ethiad Airways, of course, based in Abu Dhabi, but Katie, obviously big plans to expand around the globe. All right, we'll be back in a moment. We're going to set you up for what to watch over the next 24 hours. This is Bloomberg. All right, here in the after hours trade, the biggest mover right now is American Eagle in the apparel space, and that sets us up for what to watch over the next 24 hours. And that includes earnings out of another apparel maker, Lululemon.
Lululemon, huge fan of Lululemon. It's interesting, though, how trends shift quickly. We'll see what Lululemon has to say. Broadcom, too, also reporting. So, too, is 1-800-Flowers. A lot to look forward to. All
right, rounding out our earnings coverage here, hopefully, for this earnings season. Of course, there is some economic data to keep an eye on. The drumbeat, too. Friday's jobs number starts with the ADP numbers as well as weekly jobless claims.
Just the appetizer before we get that non-farm payrolls print on Friday, though, but still ADP coming.
Also, keep an eye on the ISM services numbers. Of course, there's been a lot of talk about some of the weakness we've started to see in the services space. We'll see if that continues. And a big hearing tomorrow on Capitol Hill that could actually reshape the Federal Reserve.
Yeah, we're talking about the Senate trying to fast track the confirmation of Stephen Myron to the Fed. A lot to look forward to.
All right, a lot of coverage here. We'll have all of it for you right here on The Close. But stick around. Balance of Power is up next.